And then there is the China export license story. Elon Musk commented on it this weekend, 6 weeks after it was announced, saying this is not good. The richest man in the world, the man who needs silver for every Tesla, every solar panel, every Starlink satellite, he looked at Beijing's decision to require export licenses for silver starting January 2026, and he issued a public warning. The media is trying to downplay this. They are saying the licenses do not mean an outright ban. They are saying silver will still flow out of China. But that is not how export licensing works in practice. When a government requires a license, they control who gets the license. They control how much metal each license allows. They control the timing and the price and the destination. It is a choke point. It is a lever that Beijing can pull whenever they want to squeeze the global market. And given the current geopolitical environment, given the trade war, given the tech war, given everything that is happening between China and the West, why would anyone assume that Beijing will be generous with those licenses? They are going to prioritize their own industrial base, their own solar manufacturers, their own EV companies, their own data centers. The West will get whatever scraps are left over, and the scraps will not be enough. So why did the price crash today? If the fundamentals are so bullish, if the shortage is real, if China is hoarding metal, why did silver drop 14%? Because the paper market is not the physical market. The paper market is a casino controlled by banks with unlimited access to leverage, and a direct line to the Federal Reserve is printing press. When they want the price to go down, they can make it go down. They sell unlimited paper contracts into a thin holiday market. And they trigger stop losses, and they create fear, and they shake out the weak hands. It works every time, until it does not. Today's crash was designed to reset the narrative. It was designed to give the mainstream media something to write about. It was designed to make you question your conviction. It was designed to get you to sell your physical silver back to the dealers at $71. So the banks can buy it at 71 and deliver it against their short positions instead of buying it at 84. This is the game. This has always been the game. And if you understand the game, you do not panic when they make their moves. You recognize the move for what it is, a desperate attempt to stay solvent for one more day. Look at the lease rates. This is the data point that tells you everything. The cost to borrow silver in London is 6.6% annualized right now. That is historically elevated. That is the market screaming that there is not enough metal available for lending. When the lease rate is high, it means holders of silver do not want to lend it out because they are worried they will not get it back. It means the metal is scarce and getting scarcer. Gold is only 1.3%, silver is 6.6%, platinum is over 15%. The market is telling you that something is very wrong with supply. And the price crash today does not change that. The price crash today actually makes it worse because it means the industrial users and the Chinese buyers and the smart money are going to back up the truck at these levels. They are going to drain even more metal from the vaults. They are going to accelerate the shortage. Here's my message to you today. Do not let them win. Do not let a 14% paper crash shake you out of a position that took you years to build. The fundamentals have not changed. The deficit is still there. The Chinese demand is still there. The export restrictions are still coming. The industrial consumption is still growing. Nothing that happened today changes any of that. What happened today is noise. What happened today is the death rattle of a manipulation scheme that is running out of time. The floor held at 71. We will be back above 80 within weeks. And when we get to 100, you will look back at today and realize it was the greatest buying opportunity of 2025. I am Asian Guy. Hold the line. Stack the metal. And I will see you on the other side. Remember to like, subscribe, and share this video. They just showed you exactly how terrified they are. They showed you the playbook. They showed you the desperation. They showed you that everything we have been saying about this market is true. And they did it with a 14% waterfall decline designed to shake you out of your position before the real move begins. Ladies and gentlemen, Asian Guy here. While you were checking your portfolio this morning and watching the red numbers flash across your screen, while you were reading the mainstream headlines screaming that silver crashed and the rally is over, something far more important was happening underneath the surface. Something the financial media will never explain to you because they do not understand it. Or worse, they understand it perfectly and they are lying to you on purpose. Silver dropped $12 today. It went from $83.90 at the London high all the way down to $71.85 by the close. That is a 14.3% decline in a single trading session. Gold lost $220. Platinum gave back nearly $400 from its peak. The entire precious metals complex got taken to the woodshed in what looks like a coordinated liquidation event timed perfectly for the moment London traders returned from the Christmas holiday. And the mainstream media is telling you this is profit-taking. They are telling you the rally was overdone. They are telling you that speculators got ahead of themselves and now the market is correcting to fair value. Do not believe a single word of it. What happened today was not profit-taking. It was a coordinated attack. It was the paper market flexing its muscles one more time to remind you who is supposedly in charge. But here is the thing they do not want you to notice. The attack failed. Yes, silver is down $12 from the high. But where did it close? It closed at $71.85. That is exactly where it was trading on Christmas Eve before the entire spike began. They threw everything they had at this market, and all they could do was erase 1 week of gains. 1 week. They could not push it back to 60. They could not push it back to 50. They could not even push it below 70. The floor is rising and they are running out of ammunition. Let me tell you what actually happened, because the story is far more interesting than anything you will read in the financial press. Over the Christmas holiday, while Western markets were closed and the bankers were sipping champagne, something extraordinary happened in China. The Shanghai silver market went absolutely vertical. The price spiked to a dollar equivalent of $86 per ounce. That is $8 higher than the London price at the same moment. $8. In a normal functioning market, that kind of arbitrage would be closed instantly. Traders would buy silver in London at 78 and sell it in Shanghai at 86 and pocket the difference. The prices would converge within minutes, but they did not converge. They stayed $8 apart for hours. Do you know what that means? It means there is no silver available to arbitrage. It means the physical market is so tight that you cannot move metal from London to Shanghai fast enough to capture the spread. It means the paper price and the physical price have officially decoupled. The mainstream analysts are calling this speculative excess. They are quoting Chinese securities analysts who say the market has overtraded the long-term positive trends. They are pointing to social media chatter and retail frenzy as the cause of the spike. But they are missing the point entirely. The retail frenzy exists because there is a genuine shortage. You do not get 60% premiums on ETFs in a market with abundant supply. You do not get $8 arbitrage gaps in a market where metal flows freely. These are the symptoms of a system under extreme stress. And instead of asking why the stress exists, the media is blaming the people who noticed it. Let me talk about the Chinese silver ETF, because this is the smoking gun that nobody is discussing. The UBS Go2 Silver LOF Fund is China's only pure play silver investment vehicle. It allows Chinese retail investors to gain exposure to silver without buying physical metal. On Friday, the fund managers had to suspend trading. They shut it down completely. Why? Because the market price of the ETF shares had risen to 60%. Above the net asset value of the silver backing those shares. 60% premium. Think about what that means. Chinese investors were so desperate to get exposure to silver that they were willing to pay 1.60 for every dollar of actual silver in the fund. That is not speculation. That is panic buying. That is a flight to safety. That is millions of people looking at their currency, looking at their real estate market, looking at their banking system, and deciding that silver is the only thing they trust. And when trading resumed today, the premium only came down to 34%. It is still 34% above NAV. In any normal market, that premium would be arbitraged away in seconds. Authorized participants would create new ETF shares and sell them into the market until the price matched the underlying value. But they cannot create new shares because they cannot source the silver. The vaults are empty. The metal is gone. The paper is trading at a massive premium to the physical because the physical does not exist in sufficient quantity to meet the demand. Now here is where the story gets really interesting. The mainstream media is reporting that solar panel demand for silver is actually falling. They are quoting Metals Focus, who say that thrifting by manufacturers has reduced the amount of silver needed per panel. They are saying the shortage narrative is overblown. They want you to believe that the supply-demand picture is improving. But read the actual data. Metals Focus projects that 2026 will be the 6th consecutive year of deficit, the 6th year in a row where demand exceeds supply. Yes, the deficit might be smaller than previous years, but it is still a deficit. Every year for 6 years straight, we have consumed more silver than we have produced. Where does the extra metal come from? It comes from inventories. It comes from stockpiles. It comes from the strategic reserves that countries and corporations have built up over decades. And those stockpiles are running out. So when they tell you the shortage is easing, what they actually mean is we are depleting our reserves slightly slower than before. The hole is still getting deeper, just not quite as fast. That is not a reason to sell. That is a reason to buy more before the hole becomes a crater.